Hello. So Shakil and Muhammad, two of you can hear me? Alright. So good evening. Welcome to class. You joined a little late. Enjoying your weekend? That is why. Yes, Muhammad, I'm seeing you for the first time in my class. Welcome to class. So what you can do is, for the previous lectures which you have missed out, you can watch the recordings. Okay? They are available at the IMTS portal. You can just download it from there and you can watch the videos for your previous sessions, the missed out sessions. Alright? Okay. So let's just start. So today we are going to discuss about the different types of markets and different types of finance. Okay? You understand finance? Finance is like the it's like the lifeblood of any business. It is in fact the lifeblood of life, but at the same time it is the lifeblood of any kind of business, any kind of activity we do, economic activity that needs a lot of finance. So in this session we'll be discussing about the different types of finances and the different types of markets. You know, there are markets for finance as well, and they are basically divided into two types: primary market and secondary market. You have any idea about this primary market and secondary market? Shakil and Muhammad. Shakil, what about you? Okay, so just listen carefully. There are two types of markets: primary market and secondary market. Primary market, as the name suggests, it is the market in which the dealings are done for the first time. Okay, and secondary market is the market where the second time dealing is done for the same thing. So we can just go to the slide and see it in more detail. Let us first discuss what is the capital market. Capital market is like, it's a market where the investment instruments like bonds, equities and mortgages are traded in. It is known as the capital market. The primal role of this market is to make investment from investors who have surplus funds to ones who are running a deficit. Okay. The basic purpose of any kind of financial market is to ensure that those who are having surplus of funds, who are having excess of funds, they are providing that money, or rather the money is flowing from those who are having excess to those who are in deficit. Like, there are some business which are in great profits. Those business men, or those people who own the business, they have ample of money, more than enough they have. So instead of keeping their funds idle or without using them properly, what they can do is they can just invest them in the in a proper place, so that that money is used by the a person who is in deficit of that money, who is running short of that fund. He can use it and both of them can benefit out of this. Okay. So capital markets offer both long-term and overnight funds. You can get funds for one day and you can get funds for more than a year. Capital market offers all kinds of funds. Okay. In business, long term means more than a year. So it can be for a year or so, and it can be even less than that. So what are the different types of financial instruments that are traded in the capital markets? Yes, Muhammad, I told now, overnight funds means just for a night means one day. You will borrow it at 1 p.m. on Tuesday, and by 1 p.m. Wednesday you will have to refund it. Okay, that is the meaning of an overnight fund. And 1 year means more than, and long term means more than a year. Yes, Mohammed, it's actually very short term. Short term normally means 1 month to 3 months, but this is very short term. Alright, so what are the different types of instruments that we see in the capital markets? Equity instruments, credit market instruments, insurance, foreign exchange, hybrid and derivative. Equity instruments means the shares, the debentures, which are floated by the companies to raise money from the market. Okay. Credit market, like bills of exchange and different types of bills which are, or rather the different types of credit instruments which are available to the business people. Those all will come under this category. Then insurance instruments, we know the insurance policies are there, different types. Foreign exchange, this again includes bills of exchange and other similar things. Bills of exchange, the primary thing that is covered under this category. The hybrid instruments are, they are a combination of two things, and derivatives are like they are the instruments which are not owned originally by the person who is holding it right now. They derive it from some other sources. We can see that in detail. Okay. Now, what is the importance of capital market? It helps firms and governments raise cash by selling securities. That it allows investors with excess funds to invest and earn a return. It channels funds from savers to borrowers. Okay, those who are having lots of money that the flow is maintained and both the parties are able to carry on with their tasks. Then it allocates resources optimally. That is, it provides funds to those who can make the best use of them. We have discussed that. It helps allocate cash to where it is most productive. It helps lower the cost of exchange. Secondary markets, where investors trade existing securities, assures investors that they can quickly sell their securities if the need arises. Okay. Secondary market is, we can say it's an intermediary market. It's a market where the dealings can be done with instant speed. So if anybody is in need of money, they can get their funds quickly from that type of a market. So now we come to the main part, the detail of the topic. What is the capital market is divided into two types, primary and secondary. Now let us see them in detail. Primary market is that in which shares, debentures and other securities are sold for the first time for collecting the long-term capital. You know, whenever there is a new company coming up in the market, or even an existing company wants to expand its business and it's in need of funds, what it will do is it will raise money by issuing shares and debentures. Okay. Yeah, I'm coming to that, Shakir. I'll tell what is share and what is debenture, the difference between the two. Shares and debentures are like we can say they are instruments which give ownership rights to the person who is holding it, not both of them. There's a difference between the two. Like shares are a we can say it's an imaginary more share depend and capital. Yes, Shakil, I'm telling that only. I'm telling about shares and debentures only. Just listen carefully the difference between the two. Okay. So shares are those which give ownership rights to the person who holds it or who buys it. Okay. And debentures are the things which are issued for the purpose of raising more money, but the person who holds them, they are not the owners of the company. They only become the creditors of the company. Okay, they are just the creditors. They don't owe it. They don't own the company. They don't have any say in the management. They are not the policy makers. They are just the creditors of the company. Okay, so the company will repay them with the passage of time, depending on the terms and conditions which have been agreed previously. So that is debenture. I'll start with a very basic difference. The basic difference is the owner of shares is called shareholder. Okay. The owner of debentures is called debenture holder. Then the owner of on shares we give dividend. The returns which are given on shares are called dividend, and the returns which are given on debentures are called interest. Okay, that is the difference. Then there are many more, and I'll just be telling you all of them. What I'll do is I'll put it on the whiteboard, okay, so that you can see it properly. Just a minute. I'll put it over here so that you can read and understand. Now like this the resolution. Alright. I hope everything is visible to you now. So a person having the debentures is called the debenture holder. A person having a share is called the shareholder. Then a debenture holder is a creditor of the company and he cannot take part in the management of the company, while a shareholder is the owner of the company. Okay. It is the basic distinction between debenture and a share. This is the basic one. Then there are many more. Debenture holders will get interest on debentures and will be paid in all circumstances. Whether there is profit or loss, it will not affect the payment of interest on debentures. Means debenture holders will be paid under any condition. Whether the company is making profit or it is incurring losses, they will be paid their interest. Okay, but the dividend on shares will be paid only if the company is making profit. If the company is running in losses, then the company is not bound to pay to the shareholders, because dividend which is paid on shares is paid out of the profits of the company. Okay, so payment of dividend is not compulsory. Only if profits are there, then only. But the payment on debentures, that is the interest, that is compulsory. We have to pay the interest on debentures. Then shares cannot be converted into debentures, whereas debentures can be converted into shares. Okay, this is a major difference. We can convert debentures into shares. So that means a person who gets them converted, he becomes one of the owners of the company in that manner. Then debentures will get priority in Shareholders have nothing to do with the loss. No, Muhammad. They are the main sufferers. They are not getting the dividend on their loss, on their investment. They have actually made investment by buying the shares of a company. If suppose Reliance Industries, it issues some kind of shares, then in that case, the one who will buy the shares of Reliance Industries, they will have to pay money to them. So that money is the investment which they are making. Good evening, Rishi. Welcome to class. You are late by almost 20 minutes. So just join. Since you have just joined in, just continue and follow what I'm saying. Okay. Right now I'm telling the difference between a share and a debenture. Okay. All right. So yeah. Actually, I'm having a little bit cold today. Alright. So, one who will buy the share of Reliance Industries is investing money in the company. Okay. So, uh, what is the reason that he should invest in Reliance? What is his own interest? What is the advantage he is getting? He can keep the money with himself only. The interest or the advantage which he is getting is the dividend which is paid by the company on its out of its profit. Okay. So if it's a big company, if it's a profitable company like Reliance Industries, then definitely it will be earning lot of profit every year, and out of that profit it will be giving dividend to its shareholders. So we were on which point? This one. So yeah, you asked a question, Shakil, I think. Shakil or Muhammad, one of you asked a question. Like, do they have anything to do with the loss? They are the sufferers if the company is having loss. If it's having loss, then the company will not pay any dividend to its shareholders. Then shareholders will not get anything. So if there is a loss, they are the sufferers. If there is profit, only then they are getting the interest, okay, in the form of dividend. Is it clear? The next one is debentures will get priority in getting the money back as compared to shareholders in case of liquidation of a company. Like in case a company goes bankrupt, it incurs lots of losses and it has to be winded up. Then in that case, those who are having debentures, they will get their money first. Whatever funds are left with the company, or rather the company may sell off its furniture, its assets, and whatever fund is raised, whatever money is raised, that will be used first for the repayment of debentures. And once that is done, if all the debentures are paid up, then only the company will focus or think about paying to the shareholders. So again, shareholders are the they are at the back seat. All right. Then there are no restrictions on the issue of debentures at a discount, whereas shares at discount can be issued only after observing certain legal formalities. Let's not get into this detail. Then convertible debentures, which can be converted into shares at the option of debenture holders, can be issued, whereas shares convertible into debentures cannot be issued. Yes, there is a separate category of debentures, that is convertible debenture. It is a type of debenture which can be converted into a share over a period of time. Okay, so if initially the company is not doing well, but in the passage of like 8 to 10 years, it picks up and it starts performing very well, then if the debenture holder is having a convertible debenture, it may get it converted into share. Then what will happen? He will be like the owner of the company. He will have ownership rights of the company. Okay. So he'll be in a more profitable state. Now let's go back to the PPT. So we were discussing about this. So primary market is the market in which shares, Rishi, we are discussing about the types of market. So right now we are on the primary market and then we will be discussing about the secondary market. Okay. Shakil, Muhammad, Rishi, any doubts so far? Okay. So this market is concerned with new issues. So therefore, the primary market is also called new issue market. Issue over here doesn't mean that kind of an issue, means a mess up type of a thing. Issue over here means issue of new shares, new debentures, new securities. Okay. So primary market is the place where the new type, new shares and new debentures are issued. So in this market, the flow of funds is from savers to borrowers. Hence, it helps directly in the capital formation of the country. Yeah. What happens is, there big industries are there. So industries are expanding their business units or they are starting up new units. So they are in need of money. They are in need of money. So they will be issuing shares to raise the money. So money is flowing from the normal people, the savers, to the borrowers, the industries. Shakil, is it so? Just wait. Now, can you see? No? Muhammad and Rishi, can you see the next slide? Rishi, what about you? Okay. All right, Shakil. Yes, in this market. Yeah, Muhammad. So, the money collected from this market is generally used by the companies to modernize the plant, machinery and buildings, for extending the business and for setting up new business units, as discussed. Okay. Now, what are the features of the primary market? It is related with new issues. It has no particular place. It has various methods to float capital. So what are the methods for doing that? First is public issue. You must have seen an advertisement on the television. A public issue advertisement is given. Then offer for sale. Private placement means through the private companies. Then right issue. Electronic initial public offer. Now what is this right issue? Let us see that. What is this right issue? The definition is written over here. It is an issue of the rights to buy additional securities in a company made to the company's existing security holders. You know, if a person is having 100 shares of the company, so now the company is again in need of funds and it wants to increase the number of shares. So what it can do is, instead of offering it to the new people, it may just give an offer to the existing shareholders that since they are having, like one who is having 100 shares, he can get 5 more shares. So if anyone is having 1000 shares, he can have 50 extra shares of the company. So that is the right issue. So primary market comes before the secondary market. So you can see initial public offering. The first sale of the company's stock to the general public means when a company is introduced for the first time, then this is the place. The primary market is the place where the where the shares are sold for the very first time. And investment bankers, financial specialists who handle the sale of most corporate and municipal securities. And for this purpose, we normally have the investment bankers or financial firms, financial banks, like you have financial banks like Barclays, HSBC, then what else? There are many more. No particular place means it. Hello? Okay, so I'm audible, Muhammad. Now I'm very much there. Okay, this happens sometimes. The connection goes off. So it's done. Muhammad wanted to chat with his friends, isn't it? But I came in between. Now, what are the factors which should be considered by the investors? So it's like promoters, credibility, project details. This is all not needed. Let's go to the next. Now, what is a secondary market? It is that market in which the buying and selling of the previously issued securities is done. Okay, like one is having shares of a company. Okay, if I say ONGC, you understand ONGC, Oil and Natural Gas Company. So one is having the shares of ONGC, and now that person is in need of money. He is having 1,000 shares. Now he wants money. So what will he do? Well, he can now resell those shares to raise the required amount, and that function will be done by the secondary market for him. Now, what is the simple name for the secondary market? Can you tell me? By what name is it known in simple terms? We use this term very now and then. It is called a stock exchange. You understand stock exchange? Everybody? Shakil, Rishi? Yes. So stock exchange is the secondary market. So the chief purpose of the secondary market is to create liquidity in the security. So if an individual has bought some security and he now wants to sell it, he can do so through the medium of the stock exchange, to sell or purchase through the medium of the, sorry, that's a repetition. So what is needed is the services of the brokers are needed. So what happens is a person opens an account in the stock market. You know what is that account known as? How trading is done in the stock market? Anybody knows? No? Okay. Actually, what happens is, in the stock market, there are like it's a building, it's a particular place. Then in that place there are financial experts sitting. Okay, financial experts are placed there, and these people, they are qualified. They hold a particular qualification for operating. Then what do? They like they get customers, they contact them, and somehow they get the customers, and they have to open demat accounts in the name of those customers. So demat accounts are meant only for share trading. Through that account only share trading is done. Okay, so like they call up, the customers call these agents and they say, please buy 600 shares for me from this company because the shares are going up. And this whole process starts at 9 o'clock in the morning and ends up at 3:30. I'm talking about India. Okay, so it ends at 3:30 afternoon. After 3:30 afternoon, no stock market is there. So what the people will, that this agent will buy shares in through that demat account of that person, and by the end of the day he will try to sell those shares to someone else so that he can realize the money of his customer, and at the same time he may incur some profits. Okay, like if he has if the price for the share is 1000 rupees, then the customer would expect that he gets 1500 for the same, so that he can, like, this 500 is the extra money which he's making, that is the profit. So it's like a lottery, it's like a gamble. Okay, stock is almost like a gamble, stock trading. Now, what are the features of the secondary market? It creates liquidity. It comes after primary market. It has a particular place. There's a building for that. It encourages new investments, aids in financing the industry, ensures safe and fair dealing. Media broadcasting, there are different channels like CNBC and Z Business. There are lots of channels which continuously, business channels are there. Those channels continuously show the stock exchange dealings. So that element of dishonesty vanishes. Now let's go to the next. Names of the famous secondary markets worldwide. That is not needed. This NASDAQ, that's the biggest stock exchange market, and it is placed in US. Okay, it's the US stock exchange market. So from the primary market comes the secondary market. That is the conclusion. So that finishes this. Now we can go to the next topic. So Shakil, Muhammad and Rishi, is this clear? Primary market and secondary market? Okay, now the next is, what are the sources of the long-term finances? What is the meaning of long-term? Long-term in business? How much time is long-term? Yes, Muhammad, it's 1 year. It's actually more than 1 year. Yes, Rishi, it can be unlimited also. Shakil, it's actually more than a year when we say long term. Okay. So this is just the introduction. There, like, no business can be carried on without the sources of finance. There are several sources of finance, and as such, the finance has to be raised from the right kind of source. Now let's see what these are. The sources of finances are of three types. One is security financing, then internal financing, and then loan financing. So what is the security financing? Security financing again means shares, debentures, okay, shares and debentures, which are issued by the company to raise money. Then internal financing is when the company uses its own resources. So one is retained earnings. Retained earnings is like every year company keeps a certain percentage of its profit aside, and then by the end of 5 or 6 years it becomes a big fund which can be used by the company for its own investment. Okay, suppose the company has a policy of keeping 5% of its profits every year. Suppose if the profits of the company is 10 lakhs, then every year 50,000 is getting deposited. So over a period of 5 years, it can be like we can say some around 3 lakhs or 3 lakhs 50,000 is deposited, is collected. Now the company is having extra 3 lakh 50,000 which it can invest in machines, building equipment, or any other business need. Okay, so that is retained earnings. Then yes, Shakil, that is also investment, but that is a private kind of investment. That's by an individual. Right now we are talking about the investments from the point of view of business. Okay, or rather we are talking about the sources of finances of business. Then there is depreciation fund. Depreciation fund is also like the retained earnings only. Every year a company keeps some percentage of its earnings for the it puts it in the depreciation fund, and the purpose of the depreciation fund is the maintenance of machinery. Like we take a machinery and we use it constantly, then over a period of time, maybe after 15 years, 20 years, maybe the machine gets damaged. It may need a replacement. Then it will be difficult to arrange for that money instantly. So what does the company do? They keep on depositing money in the depreciation fund. So again, at the end of 20 years, we may have a lot of money to buy a new machinery. So that is, this is something we can adopt, and it's a good policy because it will not burden the company in any manner. How's the weather there? How is it? The weather? Is it cold? Hello? There's no relief. Okay, Rishi, there's no cold there. India it's still cold, especially around uh, this part. Yes, I'm talking about India, Shakil. So let's now see the long-term sources of finance. They are those that are needed over a long period of time, generally over a year. So long-term finance may be needed to fund expansion projects. Normally they are for the expansion purposes only. So it can be shared, debenture, venture capital, government grant, bank loan, mortgage, owner capital, or internal accrual. Okay. Now what is this mortgaging? Mortgaging is when you keep your asset as a security, and against that you raise some money from the from bank or from some financial institution, that is mortgaging. Now, what is the need for long-term finance? It is for the fund requirement, like for modernization, expansion, diversification, huge quantities required, irreversible decision. Okay, it's normally when we have to make capital investment, like we have to buy new machineries, we have to buy a new plot, or we have to uh, we have to get the building renovated. So for that purpose, we need the long-term finance. Then the next source is debentures. So just like shares, debentures are also instruments for raising long-term finance. So it is a document that either creates a debt or acknowledges it. It is a debt without collateral. You understand collateral? Collateral security is again what I am telling you. Can I use the Hindi word for collateral? Hello? Are you all there? Okay. So I'll just use the Hindi word for collateral so things become clear. Have you heard of this word? Girvi rakhna. Girvi. Girvi rakhna. Like what we do is we keep our house as a collateral security with the bank. Then suppose we go to bank to take loan. Then what will the bank say? They will say, do you have anything to offer to us as security? Then we can say, you can keep my house. So what we'll do, we'll hand over the papers of house to the bank. So till the time the loan is not repaid, the bank will keep the papers. And once it's done, the bank will give the papers back. So till the time the papers are with the bank, the ownership of the house is also with them. So that is collateral security. So debenture is not a collateral security. Means if we are buying a debenture or if we are taking a debenture, we are not giving anything to them, but what we are getting is we are getting interest on debenture as the return. So what are its attributes or features? There is interest on that. It can be converted into share. There is security. Redemption is there. No, collateral is not an asset, Mohammed. I can say is we use an asset as a collateral security to offer to a financial institution, normally a bank. Okay, we'll have to offer something to the bank. It can be a machine, it can be the building, it can be the premises or anything, furniture, anything that can be sold and money generated. Then next is term loan. So term loan, also known as term finance, is the loan made by a bank or financial institution to a business having an initial maturity of more than 1 year and generally repayable in less than 10 years. Means when we get money from the banks and financial institutions. So it is for a particular term or for a particular time period, maybe 1 year, 5 year, 10 years, whatever. So these are the features. It's simple. It has got a maturity date. Hello. Yes, I'm there. Again, connection went off for a while. For 2 seconds, 3 seconds. Okay. Now let's go to the main part. Now another way to raise money is leasing and hire purchasing. Okay. Now leasing and hire purchasing, they are two different things. In leasing, the ownership is not transferred to the buyer. You lease your building, you lease your house. Okay. Then what happens is you take the house, you pay some amount initially, you live in the house, then maybe after a fixed period, after a period of 10 years, 12 years, 15 years, you may have to pay the lease of the house. Like the lease may be for a fixed period of time. It may be for 70 years of 70 years. Okay. So that means for that particular time period, for that 70 years, the house will be owned by you. But if and after 70 years, that will be taken by someone else. But if you pay the amount of lease in that 70 years, you will continue to own the house. But if you won't be paying it. You won't be enjoying the ownership of that. It is normally in the case of offices and buildings. People lease their building. Okay. So they get rent type of a thing. Then next is hire purchase. Hire purchase is when you get your vehicles financed, when you get your equipments financed. That is hire purchasing. Whenever you go to buy a car, suppose I say a car, then what happens is if you are not making the down payment, if you are not paying in cash and you are taking help of the bank, you are getting it financed, then in that case, what you will have to do, you will have to pay the initial amount, then the bank will fix some EMIs for you, and EMI will be equally equated monthly installment, which you will have to pay every month. Okay, and that will include some amount of interest which the bank will be charging for providing that facility, and it will be for a fixed period of time, maybe 5 years, 6 years. And once it is done, then you become the owner of your property. It can be a vehicle, it can be a simple thing like an LED or a refrigerator or something like that. Okay, so you don't get the ownership right instantly. Once you have paid all the installments, only then you get your ownership right. So this is the difference between the two. In this leasing, ownership is not transferred to buyer. In hire purchase, the ownership transferred to hirer on the payment of all installments. Then depreciation benefit to lessor, depreciation shield available to hirer. Actually, this all is not needed in detail, so I'm just going to the next one. Now, what are the other sources of the long-term finances? Initial public offering, securitization, government subsidies, suppliers credit, private placement, venture capital, bank loan, mortgage. Now, what is the securitization? Let us see that. It's written over here, you can see. Can you see? Whiteboard. Securitization is the financial scheme, okay? So it's the financial practice of pooling the various types of contractual debt such as residential mortgage, commercial mortgage, auto loan or credit card debt obligations and selling it to the third party. Okay, what is done is like suppose you have taken a car on by getting it financed, means you have taken a car on installments. So you are the debtor of the bank. You will have to pay money to the bank. So what you can do is you can transfer your the bank that means you can transfer that contract to a third party. Then third party will be responsible for the repayment of the loan and also for the payment of the installment and everything. And what your role will be, you will be like getting money from them in one go, and you will be out of that contract then. Okay. This is normally done by the specialized financial institutions. This securitization. This is not done by ordinary people. There are specialized financial institutions. What they do, they pool up the debts of the various people, like lots of people. They pool it up, and then what they do, they sell it to a third party. Okay. And they get money from the third party, and then they distribute that amount amongst these people from whose resources have been pooled. This is one way of raising finance. So this brings us to the end of the slide and also to the end of the class. So what you can do is you can just go through your teaching material, your material which you are having, and see to all these things. And in case you have problems, you can discuss in the next class so that the topic becomes much clearer to you. Alright? So thanks for your time, everybody. Shakeel, Muhammad, and Rishi. And please join the class on time, everyone, so that we can start off. Today we wasted around 6-7 minutes of the class. Alright? So good night, everybody. Bye. Take care. Yeah, happy weekend to you all. Enjoy your weekend. Take good care of yourself. Have a sound sleep. See you in the next class. Okay? Bye. Take care. And please fill the feedback form which you will get at the end. Okay then. Bye. Good night. Take care.